Canada's trade relationship with the United States is not a simple policy choice that can be switched on or off. In 2025, as new U.S. tariffs disrupted exports and political pressure mounted, Canadian leaders once again spoke openly about diversification and reducing dependence on the American market. For a brief period, those efforts appeared to show results. Canadian exports to the United States fell below 70%, something rarely seen in modern trade data. Warehouses filled with unsold goods, companies searched for alternative buyers, and headlines suggested a turning point. Yet only months later, trade flows began to stabilize, and the numbers quietly told a different story. Despite tariffs, retaliation, and diplomatic strain, Canada's reliance on the U.S. market proved far harder to unwind than rhetoric suggested. The reason lies in scale. In 2024, approximately 76% of Canada's goods exports were shipped to the United States. That share had declined slightly from earlier decades but still dwarfed all other destinations combined. When U.S. tariffs intensified in early 2025, the impact was immediate. By mid-year, the U.S. share of Canadian exports temporarily fell to around 68 to 70%, largely because some shipments were diverted or delayed. However, even at that reduced level, the United States remained Canada's dominant customer by a wide margin. Total bilateral trade in goods and services continued to exceed $700 billion annually, despite disruptions. For perspective, Canada exports more goods to the United States than to all other major partners combined, including the European Union, China, the United Kingdom, and Japan. This trade supports millions of Canadian jobs directly and indirectly, particularly in manufacturing, energy, transportation, and agriculture. When supply chains are included, trade with the U.S. accounts for roughly 30 to 35% of Canada's economic activity, a level of exposure unmatched by any other advanced economy trading with a single partner. This dependence is not the result of a single agreement or recent policy decision. It is the outcome of decades of economic integration reinforced by geography. Since the implementation of NAFTA in 1994, and later the USMCA in 2020, companies have organized production around a North American model. Tariffs were reduced, regulations aligned, and borders became logistical checkpoints rather than barriers. Over time, factories, pipelines, highways, and rail networks were built to serve this integrated system. Reversing it would require more than political will. It would require rebuilding infrastructure and re-engineering entire industries. Energy illustrates this reality clearly. Canada supplies more than 60% of U.S. crude oil imports, much of it transported through pipelines designed specifically for American refineries in the Midwest. These refineries are optimized for Canadian heavy crude, meaning substitution is neither easy nor cheap. Redirecting this oil to overseas markets would require additional pipeline capacity to coastal terminals, expanded port infrastructure, and years of regulatory approvals. Liquefied natural gas facilities, tanker fleets, and long-term contracts would be necessary, representing investments in the tens of billions of dollars and timelines measured in decades rather than months. The automotive sector is even more tightly bound. A typical vehicle assembled in North America contains components that cross the US-Canada border 7 to 8 times before final assembly. Ontario's auto plants function as extensions of manufacturing networks centered in Michigan and Ohio. Parts suppliers, logistics firms, and assembly lines operate on just-in-time delivery schedules that depend on proximity and speed. Shipping these components across oceans would raise costs dramatically, disrupt timing, and undermine competitiveness against Asian and European manufacturers. Beyond energy and autos, other sectors face similar constraints. Canadian minerals critical for electric vehicles, construction lumber, aluminum, and steel are produced to meet U.S. standards and delivered through infrastructure designed for short-distance transport. Regulatory alignment under the USMCA further reinforces this integration. Labeling rules, safety standards, and certification processes often mirror U.S. requirements more closely than those of Europe or Asia, reducing friction within North America while increasing it elsewhere. Despite these constraints, Canada did pursue diversification aggressively in 2025. Trade officials expanded outreach to Asia through existing frameworks such as the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, while also exploring new bilateral discussions with countries like India and Indonesia. Ties with Europe under CETA were strengthened, and exporters sought opportunities in the United Kingdom, South Korea, and select emerging markets. In some months, non-US exports did increase, particularly in agriculture, metals, and select manufactured goods. However, these gains exposed the limits of diversification. Even under favorable conditions, shifting exports away from the US reduced its share by only 5 to 10 percentage points. New markets were smaller, geographically distant, and often protected by their own tariffs or quotas. Transportation costs played a decisive role. Shipping goods to Asia or Europe can cost 5 to 10 times more than trucking the same products across the US border. For bulk commodities and heavy manufactured goods, these costs erode margins quickly, making sustained diversion economically unviable. Economic data from 2025 reflected this strain. Canada's economy contracted in the second quarter as export volumes fell and uncertainty delayed investment. Industries most exposed to US demand experienced job losses and reduced hours, even as companies attempted to reorient supply chains. Analysts from multiple institutions noted that diversification, while necessary as a long-term hedge, could not replace the US market in the short to medium term without significant economic pain. Geography compounds these challenges. The 8,891-kilometer shared border enables rapid, low-cost delivery that overseas partners simply cannot match. Perishable goods, energy products, and time-sensitive manufacturing components benefit disproportionately from proximity. No alternative market offers the same combination of scale, purchasing power, and logistical efficiency. Infrastructure lock-in further restricts flexibility. Pipelines cannot be rerouted overnight. Ports require years of expansion. Rail networks and highways are optimized for north-south trade rather than east-west or transoceanic flows. Even when political consensus exists, physical constraints slow change. Political factors also reinforce integration. The USMCA includes dispute resolution mechanisms and rules of origin requirements that incentivize North American sourcing. These rules were designed to strengthen regional supply chains and reduce reliance on external competitors. As a result, companies that move production outside the region risk losing preferential access to the US market, further discouraging decoupling. Importantly, the dependence is not one-sided in its effects. Tariffs imposed in 2025 also raised prices for American consumers and disrupted US industries reliant on Canadian inputs. Energy prices, construction costs, and manufacturing expenses increased in several regions, particularly in border states. This mutual harm explains why trade conflicts between the two countries have historically led to negotiation rather than permanent rupture. Canada's experience in 2025 demonstrated both vulnerability and resilience. The country proved capable of temporarily redirecting trade and expanding non-US relationships, but it also confirmed the structural reality that the US market remains irreplaceable in the near term. Diversification can reduce risk at the margins, but it cannot substitute for the scale, proximity, and integration of the American economy. Canada and the United States are not merely trading partners, they operate within a shared economic ecosystem. Tariffs can disrupt it, politics can strain it, but geography and infrastructure continue to bind it. Leaving the US market entirely would require Canada to accept higher costs, lower competitiveness, and prolonged adjustment across multiple sectors. The lesson of 2025 is not that diversification is futile, but that it is incremental. Canada can and should continue building alternative markets, investing in infrastructure, and reducing exposure where possible. Yet the idea of a clean break from the United States remains more theoretical than practical. Ultimately, Canada's challenge is not escaping interdependence, but managing it more strategically. The US market cannot be easily replaced, and attempting to do so too quickly would impose costs that outweigh the benefits. The real task lies in balancing resilience with realism in a world where economics, geography, and history intersect.